Stock Market Education Series Video Number 5. Types of Investors and Investment Strategies. Welcome back to our Stock Market Education Series. So far, we've covered how the stock market works, how to analyze stocks, and how to manage risk. Now, let's take a closer look at the different types of investors and the strategies they use to grow their wealth. By understanding these strategies, you can determine which investment style suits you best. Let's get started. Not all investors approach the market in the same way. There are different types of investors, each with unique goals, risk tolerance, and time horizons. Let's explore the most common ones. Passive investors. Passive investors prefer a buy and hold approach. They invest in index funds, ETFs, or diversified portfolios and let their investments grow over time. This strategy minimizes trading activity and aims to match overall market returns. It is great for long-term wealth building with lower stress. Many financial advisors recommend this strategy for beginners who want to invest consistently without worrying about market fluctuations. Active investors. Active investors take a more hands-on approach, frequently buying and selling stocks in an attempt to outperform the market. They rely on fundamental analysis, technical analysis, and market trends to make investment decisions. However, this requires time, research, and higher risk tolerance. Active investors often dedicate significant effort to tracking stock performance, company earnings, and economic indicators to make informed trades. Growth investors. Growth investors focus on companies with strong future potential. These are often technology startups or innovative companies that are expanding rapidly. The goal is to buy stocks early and ride their growth for high returns. However, these stocks tend to be more volatile and may not always be profitable in the short term. Growth investors often prioritize companies that reinvest profits into research and development rather than paying dividends, making them attractive to those with a high risk tolerance. Value investors. Value investors look for stocks that are undervalued compared to their intrinsic worth. They analyze financial statements, price-to-earnings ratios, and industry trends to identify bargains. Legendary investor Warren Buffett is a well-known value investor who follows this strategy. The key is patience, as these stocks may take time to rise in value. This strategy is ideal for investors who are willing to wait for long-term appreciation while buying stocks at a discount. Dividend investors. Dividend investors focus on stocks that pay consistent dividends. They seek companies with a history of stable earnings and reliable payouts. This strategy is great for generating passive income, especially for retirees. Examples include utility companies and blue-chip stocks such as Coca-Cola and Johnson & Johnson. Dividend reinvestment plans, known as DRIPs, can also help accelerate wealth building by compounding returns. Income investors. Similar to dividend investors, income investors aim to generate regular cash flow from their investments. However, instead of just stocks, they may also invest in bonds, real estate investment trusts, and annuities. These investments provide steady income and are generally lower risk. This strategy is particularly attractive to those seeking financial stability and predictable returns over time. Momentum investors. Momentum investors capitalize on short-term trends and price movements. They buy stocks that are increasing in price and sell before the trend reverses. This strategy relies heavily on technical analysis and requires careful timing. It is a high-risk, high-reward approach often used by experienced traders. Momentum investors often use moving averages, volume indicators, and breakout patterns to make trading decisions. Contrarian investors. Contrarian investors go against market trends. They buy stocks when they are unpopular and sell when others are overly optimistic. The idea is that the market often overreacts, creating opportunities for smart investors to buy low and sell high. This strategy requires patience and confidence, as it can take time for market sentiment to shift. Contrarian investors closely watch sentiment indicators and financial news to make strategic decisions. Now that we have covered the different types of investors, let's discuss some of the most popular investment strategies they use. Buy and hold strategy. This is the simplest and most effective strategy for long-term wealth creation. Investors buy strong stocks or ETFs and hold them for years or even decades, allowing compounding to work in their favor. This approach is used by passive investors and value investors alike. Holding investments long-term reduces transaction fees and capital gains taxes, making it a cost-effective method of wealth accumulation. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By buying more shares when prices are low and fewer shares when prices are high, investors reduce the impact of market volatility and avoid emotional decision-making. This strategy is particularly useful for beginners who want to build their portfolios steadily over time. Growth investing. Growth investors focus on high-potential companies, often in technology and innovation sectors. They look for companies with strong earnings growth, new technologies, and market leadership. While these stocks can be volatile, they offer significant long-term gains if chosen wisely. Investors using this strategy should be prepared for fluctuations and remain focused on long-term potential rather than short-term price movements. Value investing. This strategy involves buying stocks that are undervalued by the market. Investors analyze fundamentals, earnings reports, and economic indicators to find strong businesses trading at a discount. The goal is to wait for the market to recognize their true value. Value investors often take a long-term perspective and are less concerned with short-term price swings. Dividend growth investing. Investors following this strategy focus on companies that consistently increase their dividend payouts. Over time, reinvesting dividends can significantly boost returns. This approach is ideal for building passive income streams. Many long-term investors use this strategy to create a steady cash flow that can supplement other sources of income. Swing trading and day trading. These short-term strategies involve buying and selling stocks within days or even minutes. Traders use technical indicators, price action, and news to make quick profits. While profitable, these strategies require high skill, discipline, and risk management. Swing trading is slightly less intensive than day trading and allows traders to hold positions for several days or weeks, capturing short-term market trends. Now that you understand different investor types and strategies, our next video will dive into stock market indices and economic indicators, key tools that help investors track market trends and make informed decisions. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Tell us in the comments, which type of investor do you think you are? Let's discuss. Thanks for watching, and we'll see you in the next video.